This tool provides basic information about how to enter your information and then look up and analyze the results on the Check Your Retirement online tool. Note that no registration or personal identifying information is required to use this tool. Any financial data that you input is deleted once you close the web browser. However, you have the option to print a report with all the information you have entered, including the financial results. This tool has 3 independent sections or frames: left, center, and right. The left frame is shown at all times and will not change, but the center and right frames change depending on the selections you make on the navigation bar at the top. This tool includes a plethora of financial information, but there is no need for you to read it in order to use this tool. There are only 9 steps for entering basic information about your retirement. Steps 1 through 4 refer to your current financial situation. Steps 5 through 9 refer to your decisions about your retirement. The unlocked cells are where you enter your information, and the locked cells are automatically populated with instant calculations by the tool, letting you know the results with respect to inputs that you entered in that step. Use the Tab button to move from one cell to the next. To the right of each of the steps, you will see a question mark. If you position your mouse over it, a window will pop up with helpful information regarding that step. If you are a numbers person, click on Portfolio Analysis Table, and as you are entering your information, you will see how the table changes. If you are a visual person, click on Charts, and you will see how the charts change as you enter your information. The best way to become familiar with the tool is to enter some random financial data and see how the tool calculates, presents, and plots the information that you enter. For example, you can click on Demo and Run Demonstration, and the tool will automatically enter the financial data shown in this video. In Step 1, to check your retirement as single or as married filing jointly, check or uncheck the box at the top and to the right of the Spouse To title. The tool will keep information from both spouses when switching back and forth. To enter the birth dates, use the 2 digits for the month, 2 digits for the day, and 4 digits for the year. The retirement age is the age at which you plan to stop working, which is different from the age at which you start collecting Social Security benefits. In Step 2, enter the age at which both spouses will start collecting Social Security benefits, as well as the Social Security benefits at FRA, also known as full retirement age. Go to the Social Security website and open an account to get your FRA. As you enter this information, the tool immediately plots the 3 charts in the Charts section. Because so far there are no expenses, the tool assumes that the Social Security benefits are saved and that they will keep increasing in value. In Step 3, enter your monthly savings during your working years before retirement. For your retirement, the salary that you make before retirement is not important, but the money that you save is. In Step 4, current savings is divided into 2 groups: taxable non-IRA and tax-deferred IRA accounts. For more explanation about these 2 types of accounts, position your mouse over the question mark or read Supplemental Info, Retirement and Methodology, Step 4. At Spouse 1, age 57.2, the couple has $300,000, but at Spouse 1, age 58, the money saved has increased to $311,000 at the rate of return selected in Step 6. In Step 5, enter any pension plan, annuity, or additional income that will be received after retirement. As you enter this information, portfolio analysis, table, and column Other Incomes show the monthly values entered. In Step 6, the tool provides 3 types of investment strategies: conservative, moderate, and aggressive, based on the following portfolio investment strategies. Conservative, 40% stocks, 40% bonds, and 20% cash. Moderate, 60% stocks, 40% bonds. Aggressive, 80% stocks and 20% bonds. A tool called Portfolio Visualizer was used to determine the 10-year rate of return from 2007 through 2016, as well as the standard deviation risk volatility. For these investment strategies, the following are the rates of return: conservative, 5.02%, moderate, 6.41%, and aggressive, 6.48%. For this exercise, let's select the default, which is the conservative investment. For Step 7, go to Portfolio Analysis and select Charts. Here you can see that savings keep growing and growing to the point that at age 100, the savings are $8.3 million. Now there's nothing wrong with that amount. The reason is that the money has not been taken out of the account because retirement spending in Step 7 is 0. When you enter your annual living expenses, the tool calculates the future value of those expenses at retirement age based on the cost of living. So, let's enter $65,000 as the annual living expenses. As soon as you enter the annual expenses, the tool recalculates the annual values and shows that the money will last until Spouse 1 at age 92. Now, let's play the what if game. How many years will my portfolio last if my annual expenses increase to $75,000? According to the charts and tables, the portfolio will be depleted at Spouse 1 age 83, but what if the expenses are reduced to $60,000? Then the portfolio will last until Spouse 1 age 101. The tool answers 2 main questions. First, based on my portfolio withdrawal strategy, how many years will my savings last? Second, am I withdrawing enough money from my portfolio to maintain my standard of living? In Step 8, when constant expending, inflation, and taxes is selected as the spending strategy, the current spending increases over the years by the rate of inflation, but in today's dollars, the amount is the same. In this tool, it is necessary to differentiate between annual expenses or standard of living and the money withdrawn from savings. So the two are kept separate, and a chart shows how long savings can maintain the user's standard of living. The default withdrawal strategy for Step 9 is pre-retirement spending. In this strategy, enough money is withdrawn from the portfolio to complement other retirement incomes to pay for your inflation-adjusted spending, also known as standard of living at retirement. Therefore, the total money available for spending is equal to the retirement spending. This is why in portfolio analysis, charts, Figure 2, total money available for spending, the green line on top of the red line is retirement spending. One very well-known withdrawal strategy is the percent rule. Conventional wisdom is that if you want your portfolio to last for 30 years, then you should not withdraw more than 4% annually. But no one questions whether a 4% annual withdrawal is enough to maintain the couple's standard of living. When the percent rule is selected, the default is 4% of the initial portfolio value, and the withdrawal amount every year after that is set by the rate of inflation. Portfolio analysis, Figure 1, shows that the strategy of a 4% withdrawal is very good. The portfolio keeps increasing to a value of $1.2 million by the age 103. However, Figure 2 shows that the total money available for spending, which is the green line, is below the red line, retirement spending. So, either less money should be spent or more money should be withdrawn in order to maintain the standard of living. When the withdrawal percent is changed to 7%, the green line is over the red line, so the couple is withdrawing enough money to pay for their standard of living, which is $65,000 adjusted for the cost of living. Note that when the green line moves up, it means that you are withdrawing enough money from your portfolio to maintain your standard of living between the ages of 67 and 88. In part 2 of this video series, we will continue talking about the different strategies available in steps 8 and 9. Running Monte Carlo, when to start Social Security simulations, and how to print reports will also be covered. Thank you for taking the time to watch this video.